you try to rush things, you're likely to lose. And that's what happens to most people. So I don't know, how much do you know about investing, do you think? Tell me what you think. When you think of investing, what do you think of?
Savings.
Okay. Well, you have to have savings to invest.
You should think of stocks, bonds, index funds, that sort of
Okay.
deal.
Okay. When you think of stocks, what's the first word that comes to your mind?
Company.
Okay. Anybody else?
ETF.
Hmm?
ETF.
ETFs.
That's
Okay.
right.
What's an ETF?
I don't know what the E, T, or F stands for.
So, okay, they're exchange traded funds. They're not really, they're just a container for different things. Okay, but let's keep going. What do you guys think investing is?
I think of it as a long-term, not a short-term thing.
Okay, you win the prize. So investing is about the power of compounding money. So do you understand the concept of compound interest? Right? It's interest on interest on interest. Albert Einstein said that compound interest is the most powerful force in the universe. And that's true, because it is time dependent. So the difference between gambling and investing is, and this is important to always remember, the people who go into those buildings, the longer they stay there, and the longer they gamble, the more certain they are to lose all their money. That's guaranteed, right? Because the house has the edge. And in fact, most casinos are made up of what these days? What kind of games?
Slot machines.
Slot machines. And what's the beauty to the casino of a slot machine?
They win.
They set the payout, right? And there's machines that have very high payouts, but very infrequently. There's machines that have very low payouts that pay out really frequently. But in the end, the house is capturing a fixed, guaranteed percentage of every dollar that gets put in those machines.
Mm.
That's beautiful, because in the other games, there's a chance that somebody beats the odds and can take the house for a lot of money. That's not true in slot machines. So the longer you stay in the building, greater the chance you're going to lose all your money. Investing's the opposite. The longer I invest, the more certain I am to make money. So you should keep that in mind, especially when you have someone who says you can buy and sell and buy and sell and buy and sell over and over and over again. That's the way to make money. That's what they'll, right? If you go on Robinhood, or you talk to people about how they invest, the day traders. And day traders are just like gamblers. None of them ever lose. If you talk to them, they'll never tell you about their losses. What else is on your mind today that it would be helpful for you to know about me or about investing or anything?
Do you invest in anything other than stock? Do you invest in property or real estate?
Nope. I mean, everyone's got to, eventually, you have to live somewhere, so you have to rent something or own something.
Right.
But the important thing about investing is to know what you know, and to know that really well, and also to know what you don't know, and not presume that you have some ability to understand it. So I don't invest in real estate because I don't really understand it. I invest in public companies. So going back to kind of my story, my dad, who I was very close to, who was a real inspiration to me, and at the same time a very flawed person, he was an addicted gambler. So many times during my life, his behavior tended to cascade on the family in one way or another. But he was also a really brilliant entrepreneur. And he saw enough in me to want to get me into a great education. So he decided, for whatever his crazy reasons were, to send me to military school in kindergarten, to an Episcopal church military school. So I was the only Jewish kid in this school. So that taught me how to get people to laugh, taught me how to fight even if I lost. That's an important lesson too. Not physically fighting necessarily, but to stand up for yourself. And I got this great education, and I really owe that to the two schools that I went to from the time I was in kindergarten through high school. And then I went to Duke, which was another really remarkable place to get my education. But I learned a lot about how to stay in your lane. Like, what are you really good at? So what are you guys gonna be really good at based upon what you're doing right now?
I would suppose working with people, talking to them, building
Well, what
relationships.
industry are you all studying to be employed?
Hospitality.
There you go.
Sorry, I thought
So
it was
turn to this, so it was the perfect segue to the very first line in this whole presentation. What you know best is your greatest asset. So guess what most of you, almost all of you, aren't going to be good at? Investing. Because you haven't trained for it, right? Even if you get the basic concepts, you still haven't trained for it. What you've trained to do is to one day sit in that big room at Mandalay Bay when other people, just like you, will come before you and you'll give them an opportunity to finally get a start and to rise in their lives just like you're going to. So your own expertise is your greatest asset. Always remember that. And why is it your greatest asset? Because if you maximize your professional life, three things will happen in the order that matters most. You'll be happy, because if you're really good at what you do and you enjoy the profession, I'm assuming you've all been drawn into hospitality because you either like people or you like the operation of a hotel or an event or whatever, right? I don't know you all enough. You'll be happy, and happiness is the most important thing. It's way more important than money. I know a lot of miserable, wealthy people. They're my clients sometimes, right? So money doesn't make you happy. Money might give you other things, which we'll talk about. Being ambitious and having aspirations to be successful, that's kind of the root of happiness. I want to go somewhere, I'm going to get there, and there's a certain self-satisfaction you get out of that, right? Self-esteem. And then, of course, as you aspire in your career, you make more money, you make more income. So I want you to think of yourselves as companies, individually. You're the CEO of your own future. If you begin to think of yourself like that, you can begin to manage your life. And I think that's important. It's not just, you're not like a cork on the ocean waiting for things to happen. You're gonna manage yourself through your life. And you're gonna use the income you make to figure out how to promote your own future independence and the amount of discretion you'll have in your life. Because you all know, if you don't have any money, you don't have any choices. That's important. The oddity of being without money is that in that struggle, you build character, persistence, all of these traits that you can take with you on this journey as you manage your own selves as CEOs. So the idea is to create free cash flow. This is also a very important concept of investing. So free cash flow is what? Anyone have any idea? It says, right? It's your after-tax income, and I don't know how many of you are already introduced to the idea that the government likes to take their share of things. I think the first paycheck you ever get is an eye-opening experience, because it's like, what happened here?
Yeah.
Be frugal. That doesn't mean you want to live like monks, but be careful with your choices and really make sure they're the choices you want to spend money on today. So you mentioned stocks. Anyone have any idea what the average return of the stock market is over long periods of time?
7%. 7%.
You think 7?
8,
It's a little over 10 over time. So just to give you a sense, I'm going to teach you something now that you can remember forever. Does anyone know what the rule of 72 is?
Ooh, just like
Guys, this is one of our newest students. She's gonna sit in today as well. Do you want to go have a seat right next to Kyle? Mr. Woodman, this is one
Hi.
of the students you are sponsoring.
Hello.
Absolutely.
She just got the
Nice.
scholarship last night.
Congratulations.
Thank you.
Jerusalem as well as, oh, right here in front of me.
And-
Jerusalem as well? Yes, oh my gosh, it's Shakti. I didn't realize you were here. We have 3, that's excellent. Do we need to print any extra copies?
And I think we still have an extra one.
Yeah, we're good?
Yeah.
All right.
So, if you think about let's just say the average age of this room is what, 19? 20, maybe 18, 20, okay. So you think about this, the money you save today, if you take $1 today and invest it, on the day you decide that, you know, you want to retire, that could be 40 years from now. It's a long time to invest money. So the rule of 72 is 72 divided by the rate of return is the amount of time it takes to double. So what's 72 divided by the 10% return, average return of the stock market?
7.2.
7.2. So that means $1 turns into 2 every 7.2 years. So what happens over, let's say, 40 years? You might get 6 doubles out of that $1. So then it's 2, 4, 8, 16, 32, $64. So imagine if I said to you today, before you go spend $1, that's $1 today, but you know, it's $64 for your future. It might cause you to think, right? So when my kids were little, I have 4 kids. My deal with all my kids, because I was very fortunate through my work to be successful and to have money, is that the day they graduate college, I cut them off, completely cut them off. And they know that's gonna happen. I start talking about that when they're probably 10 or 11 years old, and get them ready. So I tell them, hey, study anything you want, but just make sure you can make a living doing that. And when they're young, I give them allowance. I used to give it to them in quarters, and they could do whatever they wanted with that. But when we were in the supermarket and you're at the checkout stand, you know, all that stuff they have there, in marketing terms, those are called impulse purchases. You know, there's, oh yeah, I'll get that. So they would always be like, of course, it's candy bars and all this business. I was like, that's great, you have the money for that, do you want to buy that? And they began to learn very early that there's trade-offs. Well, gee, I could get that or something else. So you should always think about what you're spending. So if you buy coffee at Starbucks and you get a $6 cap, you know, whatever, Frappuccino or whatever they're selling these days, or I could just get gas station coffee for $1. What's that, $5 worth over time? If I buy fancy bookshelves for my apartment after I graduate, or I just buy a bunch of cinder blocks and some plywood, I kid you not, right? I kid you not. Live simply as early and as long as you can. Because the money you put away now is the most valuable money you'll ever have in your lives. So I'm not telling you to sacrifice and live like a martyr or anything, but be careful. And being young, it's hard for you to imagine being me. But I can tell you something, to go from 20 to nearly 70, it's like that. Sounds crazy, but it's faster than you can imagine. So be disciplined about it. You're the CEOs of your own future. Manage yourselves like that. Imagine you're running a company and your paycheck is the revenue. Do you want to be a good CEO, or do you want to be one who's looked at as squandering? You have no bottom line. So maximize that free cash flow. Money, again, doesn't give you happiness. What does money give you?
Satisfaction.
It can. The effort to earn the money certainly gives you satisfaction, but what does money itself give you?
I think a little bit more freedom.
Define freedom differently.
in my terms, you're able to make, like you said, when there's no money, you kind of have no options, but when you do have money, your options open up just a little bit more.
So money gives you choice.
Yeah.
So think of money as frozen desire. Money itself, you've all heard this term, money is the root of all evil. You've all heard that if you come up in any kind of religious household anywhere in the US. But that's not true. Money is a neutral. Money's not good, it's not bad. What you do with the money is what gives it its quality. If I provide help to kids who have talent but don't have the means to go to UNLV and graduate and become hugely successful, I would say that's a moral good. If I take my money and squander it on casinos and strip clubs, probably not the same moral good, right? So you give money its value, what you do with it. So money is frozen desire. So the question you should be asking yourself throughout your life is, what are your desires? Those are the choices that I think you're rightly bringing up. Money gives you choices. Be careful with the choices you make, and make sure they're advancing you to where you want to go, right? Not just right now, today, but over some period of time. Where do you want to be in your future? What do you want to have it look like? And how do you want to be seen? And I think those are important things to understand. So money doesn't give you happiness. The happiness comes from how you deal with your money. And I'm sure you know people who, as soon as they get their hands on money, they can't keep it. It's like they've got a hole in their pocket. Try to not be that. So investing is maximizing the return on all that free cash flow. Right, so you get your after-tax income, you have whatever your lifestyle is, and you have some money left over. And what you want to do is figure out how to invest that to maximize the return on it in such a way that you can stay the course. And I'll talk more about that in a minute. So the number one enemy of all of us who have money is inflation. And for a very long time, when I started in my career in 1981, inflation was running something like 12% a year at its high. And we didn't have any, then inflation came down through a series of actions that are too complicated to want to get into today. But almost all of your lives until a couple of years ago, and for the last 40 years up until a couple of years ago, there was no inflation at all to speak of. It was very, very low. It was a very good investment environment because of that. But why is inflation the enemy?
It reduces the price or the value of the dollar.
Okay, so what if I just take all my money, because I don't want to take any risk, and I just put it underneath my mattress at home, and I just leave it there? What happens?
You lose spending power.
Right, I lose spending power. And I lose it at a pretty significant rate if inflation's running at, let's say, 3%. It means roughly every 24 years, give or take, my money loses half its value. So what if I put it in the bank? Anyone know what banks pay these days?
Like 0.1%.
Well, let's say they pay somewhere between 1 and 3, maybe even 4 if you get lucky, right? What's inflation right now?
Like
Anyone know?
2%?
Closer to 3?
Yeah.
So not really helping you out, right? It's barely, if it keeps up with, and you gotta pay taxes on the money at the bank that they pay. So it's probably not keeping up. Then there's bonds. Who knows what a bond is?
A locked in rate for a certain amount of years.
Very good definition. That's a very good definition. And what kind of rate do you get on a bond these days? 10-year treasury, the benchmark low-risk instrument in the entire world, the debt of the US government, 10-year bond, what does it pay, do you think?
6%.
5.
Slightly over 4, and it's taxable. So when you're done, you're barely keeping up with inflation if you're lucky. If you're lucky. So then there's stocks. And the first word that most people relate to stocks is risk, right? It's risky. I'm gonna come back to that in a second. How many people in here think of the word retirement and think that it just means stop working? How many of you would look forward to that? You would just stop working. And what would you do? What's the then what? And then what? Okay, you're 65, the Mandalay Bay gives you your gold watch and says, hey, thank you for your service, get out. Then what? What do you do?
Use the money that you put away when you were young.
And to do what? To what?
Enjoy your life.
Yeah.
Or are you gonna be like, you know, Charlie in the Chocolate Factory, the grandparents who are in the bed, all the- right?
The 4 of them?
Enjoy your life. What does that mean? It means something different to all of you, right?
Mm-hmm.
So I'm gonna tell you that retirement is a fiction. Nobody just stops unless they're about to put you in the ground. Nobody just stops, right? I could stop working. I don't. Right, my son is actually taking over my business, little by little, but I couldn't imagine just not doing something. I'm pretty sure if you put your minds to it, you cannot imagine doing nothing, and in fact, doing nothing is a fast track to die. So, the idea of retirement's a fiction. You're not gonna invest money, you're not gonna save and invest money to hopefully retire one day. I would urge you all to just get rid of that idea. You're gonna save and invest money so that you have choices. And if you become really, really successful in investing, you become really, really wealthy. You have all kinds of choices. Well, I don't have to do this job anymore. I could do that job. I could start a business. I could help other people start a business. I could spend time talking to young people about their futures. Right? You could do all kinds of things. But the idea that you're just gonna stop, get on your front porch, and rock in a chair until the end comes is not gonna happen. That's a very old way of looking at things. So I'm gonna tell you about retirement in America. It's a very odd thing. People learn their money habits from their parents and their grandparents. So if you go back to like 1900 or so, and imagine someone born in that year, roughly speaking, when they turn 18, a flu epidemic hit America, killed one of their parents. They had to go to work. They went to work, and they probably worked for the same company for their entire working lives, mostly doing hard physical labor. And they got to be 65 years old if they were lucky. If they were lucky, and they stopped working. Didn't really matter how much money they saved because they were dead by the time they were 70 if they were a man, and a few years later if they were a woman. And they generally moved in with their kids. Now imagine the kids of those people. They want to retire at like 60. Men will live another 20 to 25 years if they're lucky, and women, they may never die. They could live forever. Women have very long life expectancies. So, how your parents and your grandparents traverse that highway of life is different than how you're going to have to do it. You have to prepare yourselves for a much longer life, certainly than your grandparents, more likely than your parents, right? Both my parents were dead at this point. My grandfather, I think, died in his early 70s. So, with any luck, I might make it to my average life expectancy, which is like 84 or 85, something like that. So you have a much different struggle ahead of you. You have to figure out how to save and invest for a very long period of time. And if you don't take risk, you'll fail. You won't have enough. So what's risk? This is a word everybody loves to talk about. What is it?
A chance to lose.
Nope. Anyone else?
You might lose, you might win.
Well, that's true, right? But that's not what risk is.
Uncertainty.
Yeah, jumping into something you don't know.
That's uncertainty. So that's kind of part of what risk is. So let's see that circle with whatever's inside. Are they filming me or whatever they're doing?
Yes.
Let's say that's a target. Let's say I want to hit that target. Risk is the chances that I won't. So I want you to imagine, anyone here take statistics by any chance? Okay, you know what a bell curve is? You get graded on a curve ever?
Yeah.
Yeah.
Okay, when you get graded on a curve, it's a bell curve.
Mhm.
If they do it legitimately, 16% of the class is gonna get an A. 16% of the class is gonna fail. And then the rest of the grades are distributed, right?
Middle.
So that the middle of the bell curve would be a C. Right, now I know that doesn't happen anymore because teachers don't want to affect your self-esteem too badly, so everyone gets a better grade than they probably should and all that good stuff. I want you to think about this with stocks. Remember that average return is 10%? So I'll make a bet with any of you. In any given year, I'll make a bet that stocks will deliver a return somewhere between -10 and +30.
Mhm.
So that's called the standard deviation of return. 10 is what I would expect. But hey, could be 30. Could be -10. So risk is that variability. And in fact, 16% of the time could be more than +30. 16% of the time it'll be worse than -10. So what makes stocks interesting is 84% of the time you're gonna get a return between -10 and infinity. People only think about the other end. In fact, your grandparents would probably talk about the Great Depression. Right? Your parents would talk about the collapse in 08 and 09. So in my career, I have been through markets that have fallen 30 to 45% 4 times.
Jeez.
Something like that. So you can't avoid risk, so what do you have to do? No, that's not a good answer. You have to choose the risk you're willing to suffer,
Yeah.
okay? So think about this almost religiously. You're going to suffer while you invest. How you suffer is up to you. So if I put all my money under my mattress, I won't suffer the volatility of the market. What I'm going to suffer is a lower standard of living the longer I do that.
Mhm.
So the risk I chose was that I'm willing to occasionally lose 30, 40, 45% of all my money when markets do what they do occasionally. Why?
If you don't sell, you don't lose that money. And the
Well,
purpose
you don't
is,
lose anything if you
yeah,
don't sell,
and
right?
the purpose is to hold it long term anyway.
And why is that? What do you own? Do I own the stock market? No, I own shares in businesses, real, honest to goodness businesses. Now, I found those businesses and I've studied those businesses, but you don't have to do that. They've made life so simple. You mentioned ETFs, exchange traded funds. Well, one of those exchange traded funds is the S&P 500 index, the whole stock market. Just buy that. Why just buy that? Because it returns over time, 10%. And every now and again, you'll watch it do what it's doing right now, which is having a pretty ugly period,
Mhm.
right? During COVID, it had a pretty ugly period. 2008-9, it had a pretty ugly period. So I'm gonna ask you to flip to the very last No, the next to last page. And you should like take this and frame it and put it on a wall somewhere for yourself. Looks like this. And can you read what it says on the left? It's the growth of $1 over 96 years. Now, I know 96 years is a long time, but it would be the same thing over 40 or 50 or 30. But $1 invested in large company stocks, that's the S&P 500, grew to $14,000. What did $1 invested in government bonds grow to? Can anyone see that?
177.
Right.
No.
So, the thing about risk is always ask, am I being compensated for taking the risk? That's a heck of a compensation, don't you think? $177 buying the safe investment.
No.
14,000. Now, what happened in 96 years? We've had wars, Great Depressions, right? The Cold War, nuclear bombs,
Wow.
right? When I was a kid in school, we used to do once a month in LA where I grew up, the air raid sirens go off the last Friday of every month, and you had to do duck and cover drills. That means the Russians had launched, you better get under your desk where you'll be safe when the bomb goes off. Of course, that was all nonsense, but we did that. Now imagine that's the crisis. We had the Vietnam War, we had massive inflation, presidential assassinations, unrest in the streets. I mean, it was riots and all kinds of crazy stuff. And despite all of that,
Still wondering.
$1 became $14,000. That's pretty incredible. That's why Albert Einstein said compounding is the most powerful force in the universe. So think about risk as that variability, right? I'm aiming for the target, but I could wind up on either side of it in a given year. Now, if I looked at this over 20 years, instead of being minus 10 to plus 30, it's plus or minus 3, I think. Something like the worst return might be 6, and the best return was, I think, something like 13 to 14. So the longer you invest, the tighter that range of variability becomes. The lower your risk becomes over time. So think about investing as time and discipline. Let's go back now to the next page after you're the CEO. You're this one, you are the CEO of your future. Let's talk about what that means. So when I was completely broke and depressed and wondering what I was ever gonna do, I sat on the back porch of this apartment that I was renting, and I asked myself this question. And I decided there was 5 things I had to always put into play. And I would encourage you to start thinking about these things as young adults. Because not everyone you're gonna meet in your life, and this goes outside of investing, not everyone you're gonna meet in your life has your best interests at heart. And you need to understand how to differentiate between, someone who might be charming, but not necessarily good for you. And this is true professionally and it's true personally. So the first thing that is important, and maybe the most important thing, is to have a philosophy. So I'll tell you one of the mistakes that I made, and it's not a mistake I was conscious of because I was a kid, but I spent my life doing what was expected of me as a kid. I was supposed to get good grades, go into the family business, right? All of these things that were expected of me. Didn't make me happy. It wasn't what I wanted to do at all. But it was what was expected of me. And some of what I heard yesterday at the scholarship ceremony led me to believe that some of you understand that. So a philosophy is a way to look through a lens at the world. What are your values? What are your morals? And what kind of character do you want to have? So it's important for investing too, because it's real easy to say ETF. Well, there's hundreds of ETFs. It's really easy to hear people say Bitcoin, right? And it's like that shiny little object in front of you. But if you have a philosophy, you can make judgments. And the most important thing is to make judgments based on reality. And a lot of people fail to see what reality is. They're deluded. They want the world to look a particular way, or they think the world should be a particular way, but you gotta look at the world the way it is. And you have to be very clear on that, because if you look at the world incorrectly, if you see reality as something that it isn't, all of your decisions wind up being poor decisions. You'll make mistakes. And we all do that, and you'll never have a perfect lens. It's very difficult. But the most important thing to develop in yourselves is this notion that you have a belief system, that you have values, you have certain conduct, ethics, and morals, and that you're going to try and make a serious attempt to see the world the way it is and make judgments that way. It's especially hard now with social media and 24-hour-a-day news. So I don't watch news on TV, I only read. I would recommend to all of you to stop, listening to news that's a form of entertainment now, with a bunch of talking heads all trying to scare the daylights out of you or do whatever it is. This is the right-wing newscast and this is the left-wing newscast. And we're just trying to be the best of both worlds newscast or whatever. Just read. I spend almost all of my time reading. Reading matters. If you listen to a politician, if you really want to try something for fun, print their speeches instead of reading them, so then you don't hear their charming personality, you're reading their words. And begin to make judgments based on what that looks like. You'll be surprised at the differences. The reason a philosophy is important is that you've got to figure out how to make sound judgments. Well, the next point, accountability. Well, talk is cheap. So in investing, the way you keep yourself honest is to generate returns that you know are reliable. So you have to know how you're doing. Right? Gamblers. So for my dad, winning and losing at gambling wasn't even what it was about. The most exciting moment in his life was the few seconds between when he released the dice and he saw the result. And in those few seconds, you can dream. So gamblers, the fix for a gambler is in that moment. You buy a lottery ticket on Wednesday and you dream until the draw. So accountability is how you keep yourself honest. So I'm gonna buy a stock, or I'm gonna buy an ETF, or I'm gonna buy an index fund. You should write down, why did I buy it? What do I expect from it? That kind of thing, right? And then how's it doing? And you can find that stuff all over the place online. You can calculate how you've actually done. But people fool themselves if they don't. So being accountable to yourself matters. That's true in school too, right? You've all figured out that grades are the result of your efforts. Discipline matters because when markets drop, and this will be true in your careers, when a stock market drops 30 or 40% in a hurry, humans, you know what flight or fight syndrome is?
Yeah.
Right? You have this initial desire to either stand your ground or run like hell.
Mm-hmm.
That's the same thing in investing. Most people will panic and sell. It's very hard. So you have to have discipline. You have to remember it's 10% over time. This is normal. And what I tell my clients is, hey, the stock market could go down by 20 or 30% like that for no reason at all. For any reason. It could go up like that. And you shouldn't get any more excited when it goes up like that than it goes down like that. You should learn, research. What that means for you guys would be to simply learn more about what it means to be a good investor over time. And there's all kinds of personal finance sites, all kinds of articles. And you should get in the habit of doing that. It's like going to the gym. You'll keep your personal finance physique in good shape. And then just keep educating yourselves, and that's about you being the CEO of your own future. You will not stop learning once you're out of school. The best education I ever got was working and learning from people who had been there longer, people I could respect and want to learn from. And then also learning from my own mistakes, because you will all make mistakes and you will all confront failure. And in fact, if you're not confronting failure, you're just not trying hard enough, right? You don't want to, you won't get to that boardroom by being meek, right? You'll get there by showing initiative. And when you do that, sometimes things don't work out. And so you have to figure out how to keep educating yourself through that. Let's go to so DIY is do it yourself, or you can delegate. So the first question I always ask potential clients is, hey, why don't you just do this yourself? Now you think that would be not a smart thing for me, but I don't want a client for a few months or a few years. I have clients that stay with me for a very long time. So I need to make sure, it's like dating, you wanna make sure the relationship is gonna be based on the right things. So I don't want a client who thinks he has better skills than I do. Because if he does, he doesn't need me. And if he doesn't, I don't wanna deal with that person. Because he thinks he does, right? So do you have the skill to be a great investor? I can tell you right now, unless some of you are studying diligently on the side of what you're already doing in hospitality, you don't. And there's no shame in that, by the way, right? I don't have the skills you have in hospitality. And see, that's what makes free market capitalism so wonderful. We can specialize in things. And in the process of specializing, we use other people to do things that we don't or can't do. Does that make sense?
Yes.
Right? That's the beauty of what's happened in civilization. So when we were all hunter-gatherers, all we did all day long was figure out how to find enough food so we didn't starve to death. But then somebody figured out farming. When somebody figured out farming, humans were kind of freed up to do other things like make clay pots for the food that the farmers were producing and so on and so forth. So here we are today. And you all buy services all day long. How many of you use Amazon ever? Okay. They're a service, right? You couldn't possibly do what they do, but they offer you the opportunity. So there's no shame in saying, I don't know how to invest myself. That's okay, because there's Vanguard and there's Schwab. And you can go buy your S&P 500 index fund and off you go. If you do think you have the skill, the next question is, do you have the inclination? And you know, the fact of the matter is, if you have the inclination to invest, you're wasting your time in the hospitality school. So I would say you really don't. What I heard yesterday in that room at Mandalay Bay was a lot of passion for all of the things you're studying. Not one of you said, the reason I'm in hospitality school is I want to learn how to invest in hotels and casinos. So, and you certainly don't have the time. And you will hopefully never have the time, because when you graduate, you're hopefully going to be one of those hardworking people who go home after work and have time with your spouse, partner, kids, whatever you're going to do with your life. So why would you want to spend your time doing this when you can go to Schwab or Fidelity, buy your S&P 500 index fund, and not have to sweat that? And you certainly don't have the experience. In fact, at your age, and I say this with all the respect in the world, you don't have that much experience in anything yet, other than growing up. And to some degree, and to your credit, working. But you don't have a lot of experience in life. And you will, as I like to say, you will gain scar tissue quickly. And that's what life is really about. Your experiences are some form of scar tissue. And that's how you learn, and you don't repeat mistakes and things like that. So let's go to the very last page, and then I want to open this up to more questions. how many of you, right now, today, if I said to you, could you put aside $1 a day? Is there anyone here who couldn't do that? And
Wow.
next year,
He was asking me if I raised my hand, and I was like, no, I was just like this.
So, let's pretend this is the first year of your working life. So $1 a day becomes even easier, right? And then the second year, $2 a day. Now keep following that down until, what is that last year, 40 years? And then it's $40 a day, which might sound like a lot now, but 40 years into your career, it isn't. Now look to the right. What's that bottom number at the end of 40 years?
982,000.
So look at that, you're a millionaire essentially, right? Doing much less than in fact you're going to be capable of doing if you choose to. Just capturing, what's the return I put up there?
7.
So that's not even a full stock market return. Because you are going to need to have a reserve of cash, and you are going to need to balance. Most of you won't be able to fully invest in stocks and sleep at night. So this is my experience of my investment management. When I talk to clients about, or if people ask me what I do, I tell them I help people sleep at night. In fact, I don't talk to clients at first about, ooh, let's look at the returns of the stock market. I do the opposite of that. I'll sit there and say, tell me, what do you want your money to do for you one day? And they'll say, well, gee, I'm not really sure. And this is how it always goes. 40 plus years of doing this, nobody has defined goals until they're forced to think about it. And then I'll say to them, well, okay, let's talk about today. What does it cost you to live? And inevitably, people will look at me like deer in the headlights. They don't really know. So I put them through this exercise of, you need to tell me, because that's the thing that matters. So I'm going to tell you what being wealthy means to me. Being wealthy doesn't mean having millions of dollars. Being wealthy means knowing the kind of life you want and then having enough money to provide that to you without you having to work if you don't want to. So if you want to live in a mobile home in Montana on $30,000 a year, wealthy is a much lower number than if you want to live in Beverly Hills, California with 2 Rolls Royces in the driveway and a house staff. Wealthy for that person is a gigantic number, right?
Yes.
So how you want to live matters a lot. And I've had clients, I had a client who's passed away now, but he was a coal miner who lived in a mobile home. And all he wanted to do was give his money away. So for him and how he could invest and get a return that could be better than inflation and provide for his living and so on was a much different strategy than someone who says, man, I need to live in that house in Beverly Hills with 2 Rolls Royces and so on. So define how you want to live your life. That's why early on in your life, be as frugal as you can and still be happy. That's a different thing for all of you, but be as frugal as you can and still be happy, because then you get to save more. And keep a budget. So when my kids went away to college, I said, I'll send you a stipend every month, but not unless you give me an Excel spreadsheet of every dollar you spend and how you spent it. And if you don't send it to me, tough luck, get a job. And that taught them a lot about budgeting. And I would suggest that you all should keep an Excel spreadsheet of every dollar that you earn and spend. And use that as a way of defining reality for yourselves so that you're not caught up in the moment someday. You will have many friends along the way, especially at work, who spend money like there's no tomorrow. You don't want to be one of those people. You can all save more than this as you work, right? $1 a day is like a few $100s a year. So you should think about how to target a percentage of your salary upfront and pay yourself first that way. So are you gonna save X percent? And I always say, save to the point of pain and take $1 away. Then you won't be in pain. So maximize your savings early. Tell me what's on your minds now that you've heard me talk for longer than I should have.
Can I just get clarification on the last statement you just said? Save until the point of paying?
Sure. Save until the point of pain. So, oh my God, if
Mhm.
I save that much, it'll be really hard for me to get through the month. Otherwise, right?
Mm-hmm.
Then take $1 away. Then you can get through the month and save. Does that make sense?
Yeah.
So it forces you, again, you're the CEO, right? You want to maximize profit, but not at the expense of well-being. Does that make sense?
Yes.
And it's important, that money is the most valuable money you'll ever spend. Look at that chart on the back, right? Time is what makes things happen. And I'll give you a sense of things with stocks. Let's say I'm the unluckiest person on the planet Earth and it turns out you're the luckiest guy in the world, and for the next 40 years, if I'm still here, that would be miraculous. You and I make a bet. And on the lowest point of the stock market, every single year for the next 40 years, you invest $1.
Mm-hmm.
And on the highest point of the stock market, every single year, I invest $1. What's the difference in our compounding rate at the end of 40 years? A lot or a little? You get the low point, I get the high point.
I feel like it depends how low the low point is.
No, it's
No?
it's less than 1% compounded.
Oh, really?
So you got a little luckier and I got a little unluckier, but we both did pretty darn well. So all you have to worry about is saving and then investing. No matter what the headline says, just keep investing. Now, is that because I have some magical faith in the stock market? No, it's not magical faith. Capitalism forces the creation of wealth. Capitalism is this really, you'll hear politicians talk about socialism as if it has this incredible effect of redistributing wealth. It's baloney. Capitalism is way better at redistributing wealth because it takes it away from stupid people and it gives it to smart people. Businesses that don't know how to generate wealth, what happens to them? They go out of business. And just in your lifetimes, I'm sure you can name companies that no longer exist,
Came on.
right? Bed Bath & Beyond,
Oh.
right? So companies that can't create wealth, they depart. Their capital goes to companies that can create wealth. So the stock market doesn't magically create wealth. It creates wealth through this mechanism of free market capitalism. And that's the discipline, right? Unlike government, which has endless capacity to point a gun at your head and take taxes. You have to pay them.
Yeah.
Companies don't have an endless capacity to get capital. If they don't get a return, they lose their capital. So stock markets go up over time, despite the fact that not every company survives. That's also a good reason to want to buy the index. Just buy the market, because it's the market you're really trying to capture there. Does that make sense to you?
Yes.
Is there anybody else besides him who has a question? Come on, anybody.
Do you think the S&P 500 is still a reliable index despite the concentration of the 10 largest companies, comprising like 40% of the index? It brings a lot of volatility to the market.
Yes, I still think it's a reliable index. Now you can, so this is complicated. The way the index is constructed is by capitalization weight. So I take the value of companies. So if I start with the most valuable company, which might be Microsoft today, I think, but there's Microsoft, Apple, NVIDIA, so on and so forth. So Microsoft is worth, I don't know, $3 trillion. Now let's go down to the 500th company in the index, which I don't even know what it is. It might be worth $1 billion. So Microsoft carries a lot larger weight. Now, you can buy the S&P equal rated index. So everything, this is 500 companies, every position is 1/500th of the portfolio, and do that if you want. But yes, the chart on the back here says it doesn't matter. Yes, there will be excesses, right? I can tell you, you can name me 1,000 reasons why you shouldn't invest. Any, oh my God, crazy president, tariffs, oh my God, this, that, the other, there's 1,000 reasons. But over 96 years of not pleasant times, right? World wars, Great Depressions, right? Here's the market. Because capitalism works. So yes, of course, you'll go to excess. And maybe those companies could be worth more than other companies. And I think there's a good argument that they could be. But are they worth that much more? I don't know. But why do I care? Because over 96 years, that's happened before.
Right.
Before you were born, there was this internet bubble, right? Where companies that had no revenue, I kid you not, and no profit, and not even a hope for them, were trading at outlandish valuations, crazy. And then it collapsed. Well, maybe this will, or maybe it won't, or maybe they will and the other parts of the market will do better. Who knows? I don't know. And that's the important thing. I not only don't know, but because I don't know, it would be ridiculous of me to spend my brain power thinking about what to do about that, because what can I do about it?
Nothing.
Can't do anything. The more important question is, are those good businesses? Forget what the price is for the moment. Are they good businesses? And it's pretty hard to make a case against those companies. You can make a case against their valuation, right? But what they're worth. And that's what the markets are about. The market doesn't tell you what anything's worth. It just says what you can buy and sell it for. But you don't know what it's worth, and you don't have the capacity or the education. Your education is in something else. So just buy the market. And spend your time thinking about how you're going to advance yourself to the top of the hospitality industry so that you will have $1 jillion yourself one day and then help other kids just like you now. That would be the right. More important than anything else today, learn that you're not likely to be effective investors. So my colleagues, my 2 partners and myself, and now my son, over 25 years that we have a record now, because I left my old firm, and we are beating the market. We are one of maybe 5% of managers over 25 years that are ahead of the market. So that means 95% of managers, 95% of people who consider themselves professionals failed. What are the odds that you're gonna succeed?
5%.
Well, no, it's, who knows? You could be a savant. I don't know, but the chances aren't great. So don't try to do it. Just maximize your skills in what you're doing. Invest in the index.
I have a question. So I have a Charles Schwab account and I have like some money in it. I just haven't put anything towards like stocks just cause I'm scared. But like when it goes, like I know stocks are risky like we were talking about to an extent, but is there like certain types of stocks that make them riskier than others? And like, cause I'm thinking about doing the S&P 500 as well, but I don't know if I should put all of my money that I have in my Charles Schwab account towards the S&P 500, or if I should do like half or majority and then so forth.
Okay, let's talk about how you're gonna build your personal business that you're CEO of. So everyone needs a cash reserve of some kind, gee whiz, something comes up, the car breaks down, I need to move, you know, I lost my job, whatever, right? You need to find a way to keep continuity in your life. And nothing is more important than that, especially if you've come up the hard way in life. Because there's a lot of discontinuity when you grow up without a lot of means. So you should have enough in liquid form to cover a few months of disruption. Now, once you have that, then you can take much more risk, right? Because very rarely in your life will you go more than a few months without some ability to earn. And it doesn't matter these days particularly, right? I mean, I always kid around, if my entire, you know, world collapsed, I'd be a Walmart greeter, you know, because that would be a fun job. Welcome to Walmart, you know, that kind of stuff. There's always a way. I could drive Uber, right? Whatever, there's always a way to earn money, especially if you are ambitious and dedicated, and you have a college degree. If you look at the data on people with college degrees, their ability to earn money is far greater. But have a few months. And then, again, I don't know if any of you know who Ray Kroc was. He was the founder of McDonald's. He invented the phrase, KISS, keep it simple, stupid. It's like, don't complicate what you're doing. So markets are always risky, right? I'll make that bet with you. -10, +30 every now and then. Worse than -10 every now and then. Better than +30. I don't know when or why, and I'm doing this professionally. I'm very open and honest about this. I couldn't tell you what the market's gonna do this year, right? COVID, this crazy virus that no one knew what the hell it was gonna do, the market collapsed. The government, in their esteemed wisdom, shut the entire economy down. Who would have said at that moment, this is gonna be one of the better years the stock market ever had? And yet, it was. I wouldn't have guessed that, but then again, that's the point. Don't guess. You will put your money to work, and there will be times when you'll be exuberant, right? I mean, 2023, 2024, the S&P 500, both years was up in the mid 20% range. Wow, fantastic. I'm gonna plan the rest of my life like it's gonna do that. And then, of course, 2025 comes along and it starts out hunky-dory and, oh my gosh, this is great. And we elected the right guy president for the stock market. And, oh, wait a minute. You don't know. What you do know is that over time, those risks diminish. So if I said to you, what's the greater risk? Today, at your age, you're 20, 19? Okay, so at 19, what's the greater risk to you? I could put my money to work in the stock market and I could lose 20% of it. Or I'll never put my money to work, and when I'm 60, I will have underachieved for 40 years.
The 60.
Okay, so that's the point. So here's the funny bit. I'll give you a couple of things to think about. If a Martian spaceship came down to Earth and the only thing it hovered over for the last 100 years was the New York Stock Exchange, and the only thing it saw was the S&P 500 result every day for 100 years, and they went back to Mars and they went to the emperor of the home planet, he said, what do you have to say about those people on Earth? He would say, they must all be rich. So fact, stock market does really well over time, right? News, stock market's risky. CNBC, Jim Cramer, up, down, back, forth, up, down. You should be crazy to invest in the stock market, it's risky. So news and truth are two totally different things. Your job is to discern out of all of the static in the air that is 24-hour-a-day news, what's the truth? The truth, and and you should frame it and put it on your wall. That's the truth. Data doesn't lie. Reporters lie, pundits lie, advisors lie. That's the truth. Always search for the truth. Data is the source of all truth. Right? The proof of the pudding is in the eating. So, your feelings are telling you, oh my God, it could be risky. And I worked hard for this money, right? What's the money in right now?
How much money do I have?
No, what's it in?
Oh, nothing besides just my job.
What are they paying you?
Like 5 cents.
Okay, so, what if I said to you, your money is the equivalent of cancer?
Huh?
Just slowly getting eaten away until there'll be nothing left. Isn't that a risk? So ponder that idea. You gotta take a risk. What you're doing right now is, I'm the turtle ducking my head in. I'm not taking any risks. Of course, that's true, but the turtle isn't moving either, right? So as long as the turtle's sitting there ducking its head in, nothing's gonna hurt the turtle, but of course the turtle isn't getting anywhere. So you gotta take a risk, whatever that risk is. Now, let's say I say to you, you're 19, put it all in the stock market. And you do that. And then the stock market starts to go down and you go, I'm gonna freak out because it's gonna go to 0. Then don't put it all to work in the stock market. So you need insurance. Do you drive a car? Do you have insurance? Why do you have insurance?
Because if I get in an accident.
So insurance is for those risks that you don't anticipate, right? They can happen. So you need insurance. So let's follow this logic. Let's say I say to you, you can keep your money at 0 in cash at Charles Schwab, or you can put it in the stock market. And I'm just gonna pick the number of $1,000. And you say, well, gee whiz, $1,000, if I put that into the stock market all at once and it goes down, I'm gonna freak out, I'm gonna sell it, and I'm never gonna invest in stocks again because I'll be traumatized. Okay, you need insurance. How much insurance? Well, let's say I say to you, let's put half the money in cash earning nothing and half the money in the stock market. Okay? It's not 50-50. What do you earn? Well, over very long periods of time, the stock market will generate that 10%, let's say. And the cash will represent nothing. Right? So I get a 5% return. 50% is 0, 50% is 10. So I get a 5% return. That's okay. Inflation over time, somewhere around 2.5 or 3, let's say. So you just barely eke out that return. And you'll say, well, yeah, but that still won't get me where I need to go 40 years from now. Okay, well, maybe it's only 30% in cash. So pick a number. Just start picking a number, whatever it is. So let's say you put 50% in cash and 50% in stocks. And let's say your nightmare comes true. And boom, the stock market gets cut in half. Now you've got 50% of your money in, okay? $1,000, you have $500 in cash, but you only have $250 in stocks. Guess what my advice to you is gonna be? Take $250 out of that and get back to 50-50, right? I'm sorry, it would be $125 out of that, and get back to 50-50. So you pick a percentage allocation. Now guess what? If stocks go up, I know that you can't possibly imagine this happening, but let's say stocks go up 50%. Now you've got $750 in stock and $500. So you have to take money out of stocks now and put it over here, right? So whether that's your allocation is 5% cash, 95% stocks, or 10% cash and 90%, pick an allocation you can live with. And then use that, because as my first economics teacher said, if you ever give me an argument that in your heart I know I'm right, I'll fail you. feelings are valid, but they aren't facts. So that, what you're talking about is that fight or flight syndrome. Ooh, boy, stocks are rough. Now, if you had saved this money and had been through an exuberant market, you might feel the opposite. And that's just as bad. So the allocation is a form of discipline. Right? Does that make sense to you guys? Whatever that allocation is, it's a form of discipline. I think that's important. I'll point out something else that's funny about stocks. People are more enthusiastic when prices are going up in the stock market, aren't they?
Yes.
Yeah. Any other part of your life where that's true? How many people wait to get that announcement for the twice as much sale at the mall? Nobody gets excited by that. But the half off sale, oh yeah, I want to go down there and get Nordstrom's out. Yeah, I'm going to the rack.
So good.
Right? But not with stocks. Somehow with stocks, it's the higher the price, the more happy I am. That's just ridiculous, right? So stocks are the only thing I've ever seen that's a time machine. When stocks decline, so let's say half the market value gets wiped out because COVID, Great Depression, financial crisis over mortgages in 2008 or 9. It's like, well, gee, isn't that a moment? How often do you get to go way back to the last time they were ever at that price and buy them? Very rarely. And yet, people are terrified. Terrified. You go and tell people, hey, gee, Mr. Client, your portfolio's down by 40%, but we should buy. What are you, nuts? But that's true. That's when you buy. Who in their right mind says, oh, twice as much sale, I'm gonna go down and buy twice as much. So think of yourself in the supermarket. And let's just say for fun that, you know, the price of chicken has doubled because of avian flu. And you go, gee whiz, I got a budget for groceries and the price of chicken is like way up. What do?
Don't buy chicken.
What, do you starve to death?
Find alternatives.
You substitute. So when the 7 largest companies in the S&P 500 seem to be overvalued, substitute. Maybe that's when you buy the equal weighted index, right? And that's why you should learn and keep up with what's going on in the news, not so much about the trend of prices, but in what your options are in terms of fundamental choice. And just keep it simple. So you should invest, and the habit of investing will become natural to you the more you do it. And if you don't want to do it all at once, say, I'm gonna take 1/12 of my money every month for the next year and invest it in the market, in whatever allocation you choose. So keep a reserve that's in, you know, something short-term and liquid and will make you sleep at night. So that's the goal. So when I say to you, save as much as you can to the point of pain and take $1 away, invest as much as you can in stocks and still sleep at night. And that's a test that's personal to each one of us. So you could be someone like me who's done this his whole life and I am 100% invested in stocks all the time. Or you can say, that's not for me. And you can fine tune that over time. If you get more comfortable, then you'll do something different. If you get less comfortable, then save more money and invest more conservatively. So it's always the trade-off. The more I can invest in stocks, the less I have to save. The more I can spend today. The less I'm willing to invest in stocks, the less I can spend today, the more I have to save. Do you see the kind of connection to all that? What else is on your mind? That was a great question, by the way.
Thank you. I have a question. So I'm an alumni, so I've been working for a couple years, but I think what I'm dealing with right now is, like, I could invest more, but also you talked about like real estate investment earlier and how, I mean, eventually you have to live somewhere, right?
Well, hopefully now you live somewhere.
Well, I do live somewhere, but like, I'm just like questioning if I should save more so that I could own something right now. so that I could live there instead of renting out something, or should I just allocate my money to invest in more?
So, this is a question where you have emotions involved. So if you wanna be Mr. Spock on Star Trek, and you have no emotions, you can compare what I pay in rent to what I would have to pay to own a house. Now, you can own a house in a number of ways, but traditionally you would put, let's say, 20% of the purchase price down and a bank gives you a mortgage, right? There's a cost to that mortgage after taxes because the interest is deductible. And you can figure that out, right? There's a cost to that. But there's also property taxes, maintenance, right? Things like that. So you add up the cost of all that. And you say, well, gee, what do I pay in rent? Now let's say those two numbers are equal. Then I would say, well, you might want to own, right? If you're up to that, because you gotta take care of the roof and you gotta paint and you gotta deal with the gutters or whatever, right? And you might say, gee whiz, my landlord does that now, right? I don't need to do that. Over time, people look at real estate and they go, oh, well, my parents bought that home for $4 and now it's worth $5 zillion, right? But a home is where you live. It's not an investment. And believe me, by the time you figure out what you've paid to own that home, the returns are not as good as you think, right? So they can be okay. So buying a home is emotional, but if the cost of renting is cheaper than owning a home, you don't have to rush. If the cost of renting is exorbitant and owning a home might be a better deal. Now, let's say you look at a house and you say, okay, I have to put 20% down. Well, that's cash that can no longer be invested. So there's an opportunity cost. Will my house kind of go up by enough to compensate me for what that money might have done invested? Does that make sense to you?
Mm-hmm.
So, but it is emotional. So, and I can't speak for you, only you can speak for you. You may say, gee whiz, it has been my lifelong ambition to own a house, and that's gonna make me feel good and confident, and I have an anchor in the world, or however you wanna look at it. Or you might say, no, it doesn't make sense now, it's too expensive relative to rent. Or you're somewhere in between. So you have to kind of compare, what does it cost me to rent a place? Are you happy with the place you're living in?
I'm actually moving, so.
Okay, are you happy with the new place you're about to move into?
We'll find out.
Okay. If you are, then you can make that side-by-side comparison. Now, if you say, gee whiz, yes, it's true, renting's cheaper, but I'm miserable here and I hate coming home to this place, then maybe the emotional factors outweigh, right? It might be worth it to you just to have a better head about where you live. Does that make sense?
Yeah.
So I would do both things. I would calculate what does it cost to own, what does it cost to rent, and then how do I feel about it? And that's something only you can really judge. You're gonna have a long career. To the extent that you wanna buy a house or you don't, it's not a huge factor to you, believe it or not, right? Over the course of your long career. By the way, if you wanna stay in Vegas career-wise, that's fine, own a home. But if you say, you know what, my goal in hospitality is to work at the Four Seasons in Europe or something, probably not a great idea to own a house. So that's another kind of factor in the scheme of things. If you're gonna move around a lot, if you say, this is it, I'm staying in the hospitality world of Las Vegas, fine. But if your ambition is to move around, that might not be such a great idea, because then you turn yourself into an involuntary landlord, or you gotta sell the house. Does that make sense?
Thank you.
You have a question.
Yeah, I just wanted to let everyone know we have bagels over there, so you guys can help yourselves. Been back there for a minute, I just didn't wanna
Oh,
interrupt
feel
you.
free.
Yeah, and you guys feel free to grab a plate, you got the cream cheese over
Does
there.
anybody wanna go do that? That's fine with me.
Yeah, you guys can step out.
Don't want anyone to be hangry.
Just wanted to put that out there. Yeah, you guys feel free.
I was looking for it.
Go for it. And then come back when you're done. Have you guys found this helpful?
Yes.
Very,
Very.
yes. Sir, can I ask you,
For this.
where do you read your news?